Deepak, the debate of active versus passive, should you go and pick stocks, or should you just go and buy an index? Should you buy an active fund? Should you buy an index fund? That's been raging for many, many years now. So far, most of the mutual funds who've launched seem to be preferring to just buy the index for you, a global index for you. Which side of the debate are you on? And again, I'm asking this from a retail investor's perspective. Is it good to go with an active fund management approach, or an index fund works better?
So I'm biased because we are actively passive in these ways, in the sense that we actually suggest index funds for investments abroad. In fact, if you were to tell me, Deepak, I really want to go abroad and invest in the US market, I would still say go there and buy the ETFs listed there, which are index funds in the US. So I actually would prefer an indexed form of investment rather than direct stock approach, for multiple reasons. One is that it has worked. So I'll give you the example of India itself. If you're invested in the NASDAQ 100, this is an ETF by one of the fund houses by Motilal Oswal, and there is a bunch of other mutual funds who have invested their fund of funds. So they actually invest in other actively mutual funds listed in the US. So they call feeder funds or fund of funds. So you put your money here, they invest in the mutual fund in the US, which then invests in stocks. So even that approach, although the cost structure is significantly higher, the returns are significantly lower. So Franklin Feeder Fund, for instance, or one of the, if you look at one of the examples, they're both, I mean, they're excellent returns, 33% in the last 1 year, but it pales in comparison to the 45% that the NASDAQ 100 has done. And this, I think this differential has been there for a while. There is no doubt that there is that impacts your returns. The second element is cost. So if you look at the all-in cost of a feeder fund or a mutual fund in India that invests in other active funds in the US, these come with a significantly higher net cost structure of over 2%. You have active funds in India, Parag Parikh fund, for instance, who chooses part of his portfolio abroad. That fund also has a fee of greater than 1.5, I think, and that the fee excess plays a part in longer term returns, as we are starting to notice now, because these funds are now about a few years in the fray, and you're seeing that the net impact of a portfolio like this has a fee impact. So the idea is to reduce that fee impact for you. So you want to go with an index fund rather than a regular fund. Now, sometimes you might say, should I go for an ETF versus a fund? There's ETFs listed on the stock exchange in India. You could go buy those, or you could straight away buy a mutual fund from the mutual fund house itself. I see that, at least from the point of we actively participate in ETFs, the liquidity is a problem. So if you want to invest something significant, say a few lakhs or even 1 lakh rupees, you will not get the right prices by just looking at the market, because sometimes you have to see the market, and then each of these fund houses is required to note the real-time NAV, which means what is it right now versus what is it last night, which is what you get for other mutual funds. So what is it right now? Maybe 100 rupees. What's in the market could be 103 rupees. So you're paying 3 rupees extra, and it isn't uncommon to pay 2 to 3% extra in the market. So using a mutual fund approach may actually be easier for you if you're not a person who says, I can look at them and I can say I'll place an order at 101 instead of 103, and towards the end of the day I'll get somebody who hits me at 101, so I will not pay so much of a premium. So this process is time consuming. So I would prefer using an index fund for most people who don't have the time to do this. But there are lots of opportunities as well, because in an ETF you can buy intraday, if you may, where prices may come down to a very interesting extreme, and you can also exit intraday, because some of these US funds will actually take a couple of days to be able to recover funds. So that part of it is a little bit easier if you're doing it through an ETF mechanism. The index product, according to me, has not only done very well in the past. We're talking about significantly 5 to 8% higher returns, sometimes on an annualized basis of the same Indian index fund or an ETF versus an Indian mutual fund that is actively managed. So given that, I believe we should do this in a less in a less complex manner. Instead of choosing active funds, just go to passive.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.